Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, GREENBERG TRAURIG, LLP, New York Community Bank, Kilroy Metal Products, New York's Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, Cushman and Wakefield, First American Title Insurance Company of New York, F.J. SCIAME, FRIEDMAN, LLP, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, MUSS Development, NEWMARK Knight Frank, Sterling & Sterling, Stonehenge Partners, the MOINIAN Group, Urban American, W Financial Mortgage Fund.
Hello, my name is Michael Stoller. Insurance companies, the pillar of the society. The insurance companies make up the real estate market. They have been responsible for providing the mortgages, the equity. They have been the pillar of the country. And today I have three of the best, in my opinion, insurance companies from around the world appearing to talk about their view on the state of the real estate market and lending. My guests today include Melissa Farrell, Managing Director at the Prudential Mortgage Capital Company, also known as the PRU, or the ROC. Greg Walls, who is the Managing Director at Northwest Investment Management, also known as Northwest Mutual, the Quiet Company. And last but not least, Rick Coppola, Managing Director for Originations for TIAA-CREF, one of the probably the largest company handling retirement plans for
higher education.
Higher education. Thank you for all being here. So, Melissa, what is Prudential doing today with regard to providing mortgage financing for real estate?
Well, we have money to lend, quite a bit of money to still get out this year. Our appetite has been about $3 billion, and we can do more than that, we're told, if we can find the right opportunities. We're looking at good assets quality-wise, office buildings, retail specifically, grocery-anchored regional malls, and also industrial as well. We'd love to do multifamily on the life company side, but that's very difficult to do these days with
because
the
of the government agencies.
Very hard to compete on that.
Greg?
I'd like to say ditto. Basically, we're looking for the same things. Our volume is quite a bit less than Prudential's. We've put out about $1 billion so far this year, and we're hoping that we'll reach maybe $1.5 billion. Next year, our operating plan is for $3 billion to be invested in commercial mortgages.
But the interesting situation, as we were saying prior to the show, is that Prudential does a lot of smaller loans.
Historically.
Has done it historically. And you and Rick, your average loan is what size?
This year our average loan size was $98 million, which even for us is large, but that's where we saw the best relative value and less competition. And we like the markets that produce those types of transactions. So we're in New York, Boston, D.C., with major owners in...
So I hear New York, Boston, and D.C. What happened to San Francisco?
Haven't seen a lot of activity out there, frankly. We looked at a couple of opportunities, but we haven't seen enough activity that hits the credit quality that we're all trying to deliver for our balance sheets.
What about you, Greg? San Francisco?
San Francisco, we have not seen very much.
Now, Melissa, you relocated to New York from the Midwest, from Chicago. What's happening in the Chicago region? I mean, how's the market over there?
The office market is not performing as well as, say, New York. Vacancy rates are much higher. The multifamily still has the condo overhang, so everyone's waiting to see how that will play out, specifically in Chicago. Obviously, there's some issues in some of the other Midwestern markets, such as, Michigan. Not an area that many lenders will go to. Even the agencies have some restrictions in terms of their leverage.
Michigan, but it relates to the situation. What happens on situations that maybe all three of you may have lent in 2006 and 2007 on an office building, which at that time was meeting it was projected to meet a certain debt service coverage, or it was projected that the rents would go up, because many buildings in New York City specifically were purchased. People wanted them to be vacant so they could get the rent situation. And if it was a good family or if it was a good REIT, what happens in that situation today?
Typically, from the life insurance company standpoint, the leverage levels, at least for us, for office, never really, I'd say we never went above 60% at that point in time. So those loans are still performing fine. They're just probably at a higher leverage point using some different cap rates these days.
I would say that the underwriting has always been much more conservative than the rest of the market. Mm-hmm. And so a lot of those transactions we lost in 2006, 2007.
It was good that you lost them now.
Correct.
In hindsight, because I'm just thinking out loud. One of the best people, and I know all of you lent to Vornado. They're a really good company, and in 2006 they acquired 350 Park Avenue, and they said that they acquired it because they couldn't buy that corner property, a square block property, and they were hoping that the tenants would leave and they'd knock it down. So they paid too much. At that time they didn't pay too much, but in today's relative market they paid too much. They paid $1,000 a foot, and today the building is worth $400. Or even a situation where you recently financed S.L. Green's building, the Gray Bar building. Mm-hmm. 2 years ago, that building would have been worth another $50, $60 million.
Absolutely, but as we mentioned earlier, we're underwriting, based on where we see the market today. And I will tell you, when we sized that loan, our biggest challenge was trying to determine where the base rent is today in Midtown Manhattan. All that being said, it's an A-plus location attached to Grand Central. It's never going anywhere. It's not a building you would tear down to put something else up. And we certainly like the ownership. And in that center, in that building, much like most of the office buildings that probably all of us are financing, there's not a lot of leasing risk, not a lot of rollover, pretty stable rent roll, pretty granular rent roll, frankly, as well, that we feel reduces the risk of major hiccups during the term.
But, let's look at, retail. I know you've done a major retail in this market, Queens Center over there. You've done retail. You haven't done retail
Not as much this year as in years past.
But we were talking prior to the show, grocery anchor retail is good, mm-hmm. with certain exceptions. If it's a major retail, a Safeway, A&P was a strong retail. How do you look at retail, especially with retail sales down and the recession over here, which is still a recession? I don't care what anyone says. How people aren't shopping as much. How do you look at retail?
But if, for example, let's take a regional mall, and if a regional mall like Queens Center was doing $900, $1,000 a square foot in small shop sales, so it's fallen by 10% or 15%. Those sales are still very good, and I think the tendency,
I'm not questioning Queens. I'm sorry. That's a great asset. Urban retail, I think, is a different type of retail. I think urban retail is an easier retail because there's a lack of available retail in the certain market. The big thing a couple years ago were these, town centers. The open lifestyle centers, and the lifestyle center that opened in New York City, in Queens, was a failure. Fortunately, none of the insurance companies, because they were smart enough to realize that they didn't have the right mix of characters over there. What about industrial?
I think we
Jersey
all
is the
like
king.
industrial.
We all like
We
industrial.
certainly do, and we like to get it. Generally speaking, historically, we would look at it in pools of assets. So we'd look for cross-collateralized pools with major operators and major distribution centers. And for us, we happen to like bulk warehouse, which is kind of the easiest to underwrite. And generally, you get pretty good rent rolls on those. It's been tough to find those transactions this year, but we're still actively looking for them.
Can I bring up that term which many people will say I'm horrendous, and 2 weeks ago I did a show on it, hotels? I know I don't think you've ever done a hotel, have you?
We had been in that market in years past. We pulled out in 2006 when the underwriting really started to get away from us, as well as the pricing.
Greg?
We've done very few hotels. We are looking at them, but on a very selective basis. We want to have strong operating history under that particular flag with strong operators, and there's still going to be very low leverage transactions.
Well, listen, I know Prudential over the years has always been a very active hotel player.
We have been. I mean, at this
big
moment,
with a Hyatt involvement.
and for that reason, I think at this moment we're not doing hotels, or very, very selective. It would have to be the perfect hotel for us even to look at it. I mean, I guess the good news about hotels is they'll be one of the first to rebound because they have those daily leases, and we'll see that one kick up when the time comes. But
If I did this show a year ago, which I have, we may have said that rates were probably in the sevens, or even earlier this year, 7.5. Where are we now in the fourth quarter of 2009 with regard to rates for an asset that you like? One of the qualities. Where do you see a rate, and what type of?
well, I think we're in the sixes. I would say in the kind of the 6.25, mid kind of to high sixes.
A lot depends upon the size of the transaction. The larger of the transaction probably will have a little bit higher rate. I would say that probably the first quarter of this year, most everything we were doing were in the eights. And today, it's probably in the sixes or low sevens, depending upon the degree of leverage and the dollar amount.
Yeah, and I would agree that most of the transactions I've done this year have been in the first 9 months of the year, and every single one has been in the sevens, mid to high 7 coupons, for 5 and 7 year terms. So we kind of brought our duration in a little bit because of our view on where interest rates are going. That being said, I think with what we're seeing some increasing liquidity in the marketplace right today that is driving spreads down a little bit, and I think it's kind of in the mid sixes.
Prior to the show, we were mentioning that a lot of the loans that all three of you made have been to REITs.
Every single loan I made was to a REIT this year.
So every loan you made was to a REIT.
And it was a combination of refinancing some loan maturities, as well as some folks pulling some unencumbered assets off their balance sheet and putting some leverage on them.
And Northwestern, I would say the majority of the loans that we did were to REITs, but we also did some loans to a few funds and then some very large families.
And you?
Very similar to Northwestern. The first 6 months, I'd say almost every deal we did was pretty much to a REIT. And the last several months, it's been mixed with families and funds.
So
as
what
well.
happens to, let's say, an individual or somebody, a syndicate, if they buy a building? Today, it sounds like, if you're a small borrower, the doors aren't that wide open for acceptance by an insurance company.
I think that that's the bank deal. Those deals are getting done by the local banks. And maybe it's because of size as well, but I think you're right. I don't think the large insurance companies are chasing that business.
Great.
Although I haven't really seen a sale, so you mentioned for acquisition financing, we haven't seen any trades.
Investment sales are down by 83% this year, so, nationwide and New York-wise, there's a situation. How do you look at a deal? I mean, especially I gave you the example before, the Vornado deal, that 350 Park Avenue sold for $1,000 a foot, and this year Worldwide Plaza sells for $390 a foot. I mean, Park Avenue is different than 8th Avenue. I'm not questioning, but the building sold. How do you or your underwriters look at what is value?
Well, a lot of it
what is
depends
something
on
worth today?
Okay.
Well, I mean, I would say that you know, we do try to come up with value, but the more important backstop is debt service coverage. I mean, that you can calculate. You know what that is. We take a look at what the refinance risks are. And yes, we are guessing at what the value is. But, you know, again, the most important part is debt service coverage.
And I think
and
for
then
us,
the quality of the rent roll. And I mean, I think all the transactions that we're looking at have similar characteristics of being high quality rent rolls.
Isn't only, in addition to debt service coverage, isn't it really also leverage?
We look at leverage. We look at leverage and loan per square
leverage
foot.
and loan per square
especially
foot,
at the end of the,
I
at the
think,
maturity.
is a situation of what it's worth, you know, of what that asset is.
Because we weren't playing at the $1,000 a square foot range. We weren't, you know, we were, and mainly because of those levels.
But you
And a lot of those, I think those cash flows were predicated on what you said earlier, Michael, ever increasing NOIs, you know, with big spikes and, you know, the opportunity of vacant space, which we've all, I think, cut back on how we underwrite that.
You know, Greg said prior to the show, or maybe all three of you said, what's happening today is many of the insurance companies are acting like clubs, syndicating deals. Is that a fact?
On the larger deals, we absolutely are teaming up on transactions.
So
to get a $200 or a $400 million transaction done today, it just makes sense. And I mean, I think we've all done enough club deals. I mean, we've done club deals with both of you, that it's gotten a lot easier.
Especially on single asset transactions, where you don't want to necessarily be over $100 million on a single asset transaction just for exposure issues. So you'd like to club up with
even
somebody.
we did a portfolio transaction earlier with you this year on some Simon malls. And I mean, that was a fairly easy transaction to do.
you know, taking into consideration, you know, since Rick said that all of his deals this year have been with REITs, and a good large part of yours have been with REITs, what happens now that the REITs have been able to hit the capital markets and raise close to $16 billion in funds? How do you see that? I mean, if Boston Properties could raise money at 5%, why do they have to borrow from you at 6%?
I think that there'll still be opportunities, but I think that the best opportunities were in the first half of this year to access that market. I think it was a lot easier to make loans to Simon when they were borrowing in the public markets at 10 3/4 than at where Boston Property is today at 5.5. That being said, I would expect that they will continue to access all parts of the capital markets just to hedge their bets to a certain degree. I mentioned earlier we had done a deal with Vornado. It's not a large deal. It was less than 90 million. The loan we did was about 80 million. Not a huge deal relative to their balance sheet, but I think that they want to make sure that they have those relationships to look to in case the capital markets, you know, get a little bit soft again.
Do you see, you know, the CMBS, the collateralized debt mortgage business was there. You were in the business. I mean, Prudential was part in that play. I didn't think you were.
We dabbled in it,
but not really.
Not
you guys weren't.
No.
Do you see? I mean, and that's why the world has come to an end on investment sales and everything, because it hasn't been. Do you see this coming back? Do you see Prudential coming back in putting deals together and then selling it to Wall Street?
Well, I can't speak for Prudential
No,
per
I'm
se
just
in
saying,
that, but I think there will be some sort of market to come back, and I think you're already hearing people talking about that. You know, TALF is probably the first step in that direction. But you hear people saying, well, maybe we will warehouse some loans, and maybe we will put something together, maybe sell them in the TALF program versus, you know, an actual securitization. But, you know, I've heard rumors that now that the spreads have come in, I don't know, it's been 150 to 200 basis points since the beginning of the year, that it might actually be more attractive to go back to securitization, though I think it will change.
I would think it would have to change dramatically. I think that the issuers of CMBS is going to have some skin in the game. I think one of the other big issues is, what about the rating agencies? I mean, there hasn't been very much discussion about rating agencies and their role in this, but they did have a fairly significant role.
Unfortunately, last year I moderated a panel. We had somebody from the collateralized debt business, we had a person from the rating agency, and we had an appraiser. And I didn't want to hurt the young person from the rating agency, but I said, how do you rate something? And their explanation of how they made a judgment on to give a rating was totally inaccurate. I mean, they didn't look at debt service coverage, they didn't look at the appraisal, and I said, how do you know what the property was worth? I mean, so I think part of the demise was the rating agencies and the underwriting. It was greed. I mean, you remember all of you have been around in the 90s, so you remember the real estate. Do you see, if you had to look at this, is it a better time today for insurance companies in 2009 versus the mid-90s?
I would say absolutely. And I would say that the loans that we're making today, and I think we would all echo this statement, are the best loans we're probably going to make. They're the most conservatively underwritten, and there's just a lot of downside protection that I think that these will be loans we'll put to bed for a very long time. And remember, we're holding these things. We've got that credit view where we're holding these for the long term.
Yeah, I would say that this would be very similar to the early 90s.
Yeah,
that's what I was trying to allude on.
Yeah, I mean, I think in
mid-90s.
96, things started to get heated somewhat,
Right.
but 91, 92 was a great time to be in that market.
Do you see any of the three of you going back into construction lending for anything in the future?
I wouldn't say this year, but I think probably sometime next year we would take a look at it.
We have actually bid on a few construction loans, construction perms, I should say. Now, it was to
establish
a GSA lease, so you had a fairly high degree
you had to
of
take
comfort.
out.
Right.
There was a situation over there, no question. What about? I mean, all of you. I mean, you're in the mortgage side. Also have divisions that invest in the investment with companies. You've invested with certain families and REITs in joint ventures. Do you see the insurance companies going back into investing with the equity funds and with the successful families, and so on?
I think there's appetite for ventures with people that own trophy assets in major markets. And I think that a lot of us see this as an opportunity to get to assets, whether in venture or wholly owned.
But I think that's a great point, because I think what the real question that I was going to ask was, let's say that some of your borrowers that you've had this good relationship have the opportunity to buy the debt on a property because it's in default. Or, let's say you had a great borrower who could have bought Worldwide Towers or 1540 Broadway, and they're buying it at a deep discount, but there may be a little hair on it. The may go into a foreclosure. Do you think that insurance companies would do that today?
I would say that we're looking for really the core opportunities. We think that there'll be those types of opportunities that you described, only on core assets.
Yeah, and I would think that going through a foreclosure is probably something that we would not want to do. Yeah. I think that's clearly a tool that we have in our toolbox, but we don't want to bring that out for any asset.
No, I'm talking about trophies or somebody who's a good borrower that maybe you've done business with over the years. We're in New York City. New York is an anomaly. What about New Jersey and Westchester? What's your views as an insurance company lending? Prudential is created in Newark and all the rest. Where does Prudential look at the New Jersey market today?
Well, we continue to kind of look at the primary markets. We will take a look at, say, a New Jersey office market or something of that nature, but it would have to be with the right sponsorship at the right leverage level. I think you wouldn't look at that as a primary, but you would say maybe that's more of a secondary market, so you would go there under the right circumstances.
Greg?
And I would agree. And sponsorship is so important that if you're dealing with the right sponsor, I think you get to feel a little bit more comfortable. But I would say that there are other parts of the country that we're also taking a look at.
Rick, I know you live in Connecticut, and Connecticut had, Greenwich was hot. People were paying $1,100, $1,200, $1,300 a foot. How do you look at Connecticut today?
I think we're a little bit concerned about the spillover effect. A lot of markets kind of benefited from that $1,200 a foot in Greenwich. So we're waiting to see how that ripples through Stamford and some Westchester markets.
I mean, because Stamford is down, isn't it?
Yeah, absolutely.
I mean, the Greenwich and the Stamford market is
there were some
truly-
hedge funds up there as well that were taking up space, and it's a little bit more challenged now, I think.
What about yourself?
Well, I mean, I
Connecticut,
think
New
you
Jersey?
can make quality loans in any market. It's a matter of structure, of sponsorship, of taking a look at the rent roll to see how solid the rent roll is. So, it's difficult to make blanket statements about, I will not go to this market because of fill in the blank. Because I think all the markets around New York City is suffering that ripple effect of having the job loss that New York City has suffered.
But the job loss has also happened in New Jersey. Job loss has happened in Connecticut. So, I think it has that rippling effect. And I think that, the market is, it'll be resuscitated. I think, things are working out better. I think insurance companies who are the pillars of lending will continue lending. And, only time will tell. But I'd like to say, I think today I got a pretty good perspective on the state of the market. And needless to say, I know that the reason I've had the three of you on the show is that you're going to be all lending in the balance of 2009 and 2010. I'd like to thank Melissa Farrell from Prudential Mortgage Capital, otherwise known as the PRU, Greg Walsh from Northwestern Investment Management, aka Northwestern Mutual, and last but not least, Rick Coppola from TIA CREF. See you next week.
Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, GREENBERG TRAURIG, LLP, New York Community Bank, Kilroy Metal Products, New York's Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, Cushman and Wakefield, First American Title Insurance Company of New York, F.J. SCIAME, FRIEDMAN, LLP, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, MUSS Development, NEWMARK Knight Frank, Sterling and Sterling, Stonehenge Partners, the MOINIAN Group, Urban American, W Financial Mortgage Fund.